Welcome everyone to the Real Estate Toolbox. And in today's episode, we're talking about the state of hard money and private money in what is this? February 2023. And my guest today is Rafael Islam from Private Money Specialist out in California. And he is going to give us some expertise on where the market is and how it can, I guess, how we can navigate it in these times. So, Rafael, thank you for being here. Thank you for coming on. I appreciate it.
Yeah, thanks for having me, Greg.
All right. Well, so you and I are friends, so I'm not gonna sugarcoat these questions. But so what is it? What's the state of hard money right now? Like, there's obviously a lot of moves. If you guys are following hard money, you know it, that lending has changed in that space. And what do you see so far?
Things have changed a lot. You've seen it from regular home loans. Interest rates during COVID were like 2.5, and then overnight it went from like 3% to 3.5 to 4. Now a mortgage can go from 5 to 7%, and that's a normal loan if you went to Bank of America, Chase, a mortgage broker, whoever. And private money, hard money, whatever you want to call it, is essentially the same thing, exchange as well. So there's a couple of different credit boxes, so to speak. One is rates have gone up, just like everyone else's, right? During COVID, you can get hard money rates, private money rates anywhere from 7%, so as high as 9.5%. And now, it's 9.5 to as high as 14%. And the shift is happening pretty quickly because the appetite for Wall Street buying these like buying these loans on the secondary market is changing every day. So since they
And
are
that
buying less,
actually that just to put a pin in that what you just said, and maybe you can explain that because I see that come up like in the Facebook groups, but that a lot of people don't understand about that secondary market, or that your private money loan, your terms of your private money loan, hard money loan, can be dictated based on that secondary market. And why don't you just, I guess, explain to those who don't know what how that affects their loan or what it means for their loan.
so I'm gonna try to keep this simple so I don't get so jargony,
All
so
right.
industry. So at the end of the day, when any private money lender, say if you went to a company like Civic, Finance of America, Patch of Land, these companies are institutionally backed, meaning Wall Street or a bank is giving them their money. So when the bank's appetite for risk changes, they increase the rates, they do things of that nature. But when your loan is closed, they fund your deal. Civic, Patch of Land, these companies have like 200 loans that they just did, right? And that can be like $150 million worth of loans. Then they go to Wall Street, you can say like a stock exchange, and sell that 150 loans to a hedge fund, to JP Morgan, whoever's buying. And if their appetite changes, meaning that you were doing 8% loans, the market is now 10%. I don't want to buy your 8% pool of 150 loans. I want 10% now because that's what market is. And that's why those private money lenders in turn increase the rates. That kind of that hit
Yeah,
the
no,
point.
that is it. I mean, that is the driver in the secondary market. Um, if they're paying more, you're paying more. Is,
Yeah.
I guess, in short terms. But yeah, so interesting news, I guess, this week and last week about a couple of big, I guess, sources for hard money, private money, that kind of loan. There's been some changes, huh, in that
There's been
business.
some big changes. Civic Financial is one of the bigger private money lenders in the space, and the CEO just stepped down or left the company last week, and they've increased their interest rates, and we don't know what's happening with them at this time. I saw a post on LinkedIn saying, we're still funding deals, we're doing this and that, but if I'm hearing from other people, hey, they're not closing their deals, they've increased their rates. Usually, when people are increasing rates, they're usually trying to prevent more deal flow to come in because they're trying to fix whatever they need to get fixed.
Yeah, yeah, that's common. So basically, a lot of lenders will, and you see this like in the regular traditional loan space, a lot of lenders will raise their rates to slow down that drip coming in, and then make some fixes, catch up, do guideline changes, and then they'll turn back on the faucet, lower the rates into a more reasonable area. So that is definitely a common practice across the board, a strategy, I guess you would call it. But yeah, that's a good point. Another thing is, I have a note here, like how is that affecting the market, these places closing? Like how is
They're
that
not
changing?
closing, but their guidelines
Or
are
yeah,
changing. So it's making it difficult since they don't know what they can sell on the back end. That's an institutional type of lender. So they have to change their credit box. So meaning, that might lower the leverage. And what I mean by lowering the leverage, like instead of doing 20% down, they may want 25 or 30 or 35% down. To give you an example, those are not hard numbers, but to give you an example, they would want more, I guess, skin in the game, so to speak, from the buyer, from the borrower, whoever is going to be investing. They're flipping a property, or they're going to make it into an Airbnb. So that would make it less riskier for them.
how is I guess them doing taking that approach, how is like the state of values uh affecting all this? Because I know like ARV is really hard to come up with right now. Even value is tough on a declining market. There's not a lot of action. There's a lot more, uh, you know, just areas that are dropping. Um, how is that affecting the private money space as well?
It's definitely making an effect because there's a lot of variables that's involved, right? It's not just okay. The private money lending is one aspect. You're gonna get a certain amount of interest rate. You're gonna do whatever it is to fund your deal to that investor, and that investor is gonna go along and fix up that property, and his job is to fix that as possible and throw it in the market. But now, on the flip side, if your rates have gone up, guess what? The regular average person, when they're going for a conventional loan, a regular basic home loan that you would get from Chase or Bank of America, their interest rates have gone up too. So now, if you're flipping that house, who are you selling it to? Is it going to be a brand new family? Is it someone that's stepping up to a brand new home? Can they afford that home at your price point that you're trying to sell it at, which is your after repair value? you know, there's a lot of things going on. And during that time you're trying to flip that property, guess what? Construction has gone up. Labor is more expensive, material is more expensive. Can you get that paint or you're trying to put into that property? Everything has gone up. So now your numbers are going to change once you're done. Well, you have to reduce say your ARV is 350. You have to change it to 325 now to make sure it sells because that person may not qualify for 350 anymore. Because remember, interest rates were 3% roughly about, I want to say like 7 to 9 months ago, somewhere along those lines. And now they're 5, 6%. That dramatically changes, your end buyer's buying power. They could be qualified for 450,000, no problem. But now with the interest rate at 6.5, it's a different game.
True, very true. Now, with all that being said, uh, did you guys change any guidelines for qualifying people? Has any
Uh,
since let's call it, this market depleted, let's call it December of last year, has there been any changes as far as like a borrower has to consider that's new?
I would say values. You
Mm,
can't go off of that. Like if you say if you're you said December, you can't use values from summer of 2022 because that was like almost the height of it, right? We were coming down during that time. So now those comps don't match up to the comps that are selling in December. Because that's a way bit from summer to December. So many things have changed that the values changed. So now you can only go back maybe 30 or 60 days for a value. You can't go back 6 months. So there's not enough activity in that area. We don't getting hold of the value of the property is a little bit more difficult now. And also another note when you're since we are talking about flipping and also maybe short-term rentals, maybe doing like an Airbnb or just buying the property as a rental property, using reading CoreLogic's new data, rent has gone down 5% nationwide. So
mm,
rent is coming down as well too. So not only are
yeah.
values coming down, rent is coming down.
Yeah, I had actually noticed that I have some good friends that are investors, and they have a bunch of rental property, and they too have lowered their expectation as far as how much they're going to get for rent. They just had one come up on the market, and literally a year ago, it was going for $200 more, and now they're taking $200 less. And actually,
Yeah.
it hasn't even completed at that $200 less. I think it's still looking for a tenant. So yeah, I don't even know where that's going to land, but obviously it's not going to land where it was, and that seems to be a common thread, just from talking to guys like you, and like that is a common thread for sure.
Yeah.
People are
And
people are biting back, like the consumer is biting
yeah,
back.
like, right now, wherever anyone lives, you go to the grocery store, you feel it. Things are more expensive. You drive your car now, things are more expensive. Everything is a little bit more expensive. Rent during COVID, the values of homes was an anomaly. Things should not have increased the way that they did. Same thing with rent. It's not, what am I trying to say? It's not, you cannot go in that same trajectory. You can't continue to go up and up and up. Whatever goes up has to come down, right? So when it comes to rents,
Yeah.
like if it's $1,800 a month, that's what market rent is in your neighborhood. You can rent it, you can try to rent it for 1850, 1900, or you can rent it at 1800 or 1700. But you have to weigh the risk and the reward. Say market rent is $1,800 and you have two tenants. One can be the $1,700 tenant or the 1850 tenant. Making $50 over market rent sounds cool. And then sound $100 less doesn't sound so good, right? Eats into your pocket, your profitability. But what tenant is more consistently going to stay in your property? Say over a 24-month span, if $1,700 that tenant is going to be there for 24 months straight, or even longer, you have less vacancy versus it having being on a higher rate. That guy that's paying 1850, he probably know if he needs a place, he needs a place, right? He can't find anything. But the moment he can save in 100 or 150 bucks, what if he leaves after month 13 and it takes you 2 months to get someone in there? You have to put in your vacancy factor
Yeah. And
and
I
your
think,
marketing and your time.
and I think a great case in point is that people that are out there renting at, whatever, like $500 below what the market is, they're happy. They're
And
good,
they're not
and
going
they're not
anywhere.
late. And they're not
Yeah.
late. They're like, what do I need to pay? Because they're looking at all the $2,000 a month, and they're only paying 1,200, and they're like, yeah, we're good here. Here's your
Yeah.
money. Yeah, for sure that does change consistency. But so just real quick, because I want to touch on this for someone maybe that doesn't have a private money loan yet or hard money loan yet. And I kind of refer to them as the same because, it is a private entity, whether, you know, you like it or not. So private money, hard money, it's all the same. If you wanted to say private money, is not like hard money. Like that would be like your uncle lends you money, something like that, privately. That would be private money. But if you have to send an app and all that kind of stuff, you're looking at you're leaning more towards it would be called hard money. But either way, it's just a loan. You know, it's just a loan that has a higher interest rate. It still has guidelines you need to follow, and they still have guidelines they need to follow to protect the consumer. So, you know, it's a win-win for everyone. But I did want to ask, like, currently in, you know, late January of 2023, what are the requirements for a hard money loan, to get one, to apply for one? And I guess I know it varies based on uh, scenario. Like, is it a refi? Is it a purchase? But I guess let's just say this is a purchase, first timer, and they want to buy this property, rehab it, and possibly buy and hold it and rent it out, or they may flip it, but they're you know they're just in that middle there of trying to figure out which way the market goes by the time they're done fixing it. What would be the items they need to qualify?
It's really basic. When you're doing a short-term loan, you might heard the term bridge loan, private money, hard money. Essentially, it's just a short-term loan. So typically, it can be anywhere from 6, 12, or 18 months. And what you need to qualify is really basic stuff. Driver's license. We do pull a credit report. We would want to know what the purchase price is, how much you're going to put into the property, so like a construction budget, and we're going to want to know what you think the after repair value is, which is the ARV. If all that makes sense, depending you are a first time flipper, so we may be anywhere from 65 to 75% ARV. Meaning if your ARV is 300,000, we'd give you 65 to 75% of that value.
And then like, how does it work with purchase price? So they're acquiring the property. The ARV is supposed to be 300,000. Let's say they're acquiring it 200,000, right? How much would they need to bring in for down payment
For a first timer, you're thinking 20 to 25% down
of the 200?
of the 200,000.
Okay.
So typically you can think 40 to $50,000.
Okay. And I did want to touch on, because I see this in the groups as well a lot on Facebook, but there'll be the big debate about a real hard money lender shouldn't be pulling credit. They shouldn't care about credit. Like, what is the story behind that? Like, why do you guys pull credit?
Well, one, we want to know who you are. We want to see, hey, do you pay your bills? Do you have child support? Do you have things that we need to know of? Because we want to verify who you are. And we also pull a background check as well. So you can't have a background, you can't have a criminal record, and we're just going to loan you the money.
But
So
it,
if
but if
anyone's going to loan,
I think I'd be asking for, because I see a lot of people that maybe they have bad credit, and there'll be a lot of hard money lenders that say we lend with bad credit. Um, how is that happening? Like, how does that? Are they still getting a credit report? You know, even
you're
the
still
bad
pulling a
credit.
credit report.
Yeah, my understanding is that even the bad credit, they still need a credit report, because the credit report gives information that kind of validates who you are, you know, and if they're cutting you a check for
Exactly. Like we're
six
going to have your
figures, yeah,
date of birth. We're going to have, exactly. We're going to give you
yeah,
X amount of dollars. We want to know, okay, are you you?
yeah, yeah,
We're not just going to wire you. If someone's going to give me a call, hey, you're going to call Greg, you're going to give me a call. It's like, hey, I need 200,000 to flip a house. Okay, what's your bank account information? Let me just wire it to you. Where's the
yeah,
security in it for us as a lender? That
yeah,
doesn't make sense at all. So
yeah.
I've seen in the groups that they don't pull credit. We pull credit.
And then
And if
what
they don't pull credit, they're doing soft checks anyway. They want to verify you are who you are.
what is a soft check? Just to
A soft
clarify.
check is still we're getting your driver's license information, first name, last name, where you currently live, and we pull Experian. So we'll pull one credit bureau versus all three, and it's not a hard pull.
And
But
then what?
regardless,
And if
go ahead.
the score comes back low, do you guys, sorry to interrupt, but I just, because I do get a lot of questions about this, but if the score comes back low, what, how do you guys work with that?
It's normally we don't really care if it's a fix and flip loan, and usually we want 650 FICO score or higher, right? That's essentially what we want. If it's lower, is it still possible? Yeah. But now that we're going to view it as you possibly might be riskier. Why is your credit score there? If you have old collections accounts, not a big deal. Who cares? Oh, you have a bankruptcy in the last 2 years? Yeah, that's a flag for us.
But
So,
there is loans though available for people that have those
um,
credit
we've
enhancements.
closed, I've closed deals with FICO scores of 500. We,
I know that you've closed loans too with current mortgage rates, which blows my mind, but in multiple lines. So for those out
yeah,
there, Rafael definitely gets some weird outside of the box deals done. Believe me, I've seen it, and I don't know how he does it, but good on you, I guess. But
well, at the
it's
end of the day, if
the
the deal makes sense, we're going to do it, right? But
yeah,
going back to what you're saying, lower FICO score, the terms might be different.
yeah.
You might pay a higher rate now. You might need to bring in an extra 5% of the purchase price. The rehab funds, we may give you less upfront rehab funds. There can be a number of things we may adjust it, or we may even cross collateralize another property so it's less riskier for us. Because when it comes to flipping properties, one thing that private money lenders do not want to do, they don't want to foreclose and they don't want to own that property. We don't want to go in there and fix it up ourselves and sell it. That's not our business. We're here to loan investors money so they can go flip properties.
Mm. Yeah,
And
yeah,
that's
I
why it's
know it.
important to have that relationship.
Yeah, it is. That's the one thing I see that too in some groups where they'll be like, oh, the greedy uh lender just wants another property, and I'm like, really? They don't. They just want like to make
Yeah.
their money without the friction because they chose that way to invest their money, and they just prefer just to have mailbox money. They don't want to go through all the hassles, or they
Yeah.
would have just been real estate investors.
Well,
Um,
I'm going to tell a little story really quick about that low FICO score type of flipper. There's this client back in Florida. Credit score was like 550 to 590. We were just like, whoa. And he was trying to pull money out on a property that was half fixed, which to us is all red flags. But we talked to him and we found out what happened. He had some medical issues, long story short, some family emergencies, but he also flipped 5 properties prior in the last 2 years. So he had the experience. He had a little misstep, and the only difference for us was we still gave him the loan amount that he needed, but the rate was just like 0.5% higher, and that was it. And we still got the deal done. So credit is not as strong. A bunch of medical lates, bunch of his some of his credit cards were overutilized because also he's spending money out of his own pocket to finish the renovation so he can flip it. And he was also a real estate agent. So at the end of the day, we got the deal done for him. Credit was bad, but the story made sense. He had experience in that specific market. He's a realtor. He had a track record. So if the deal makes sense, we can fund it. That's why it's important to like establish a relationship with a lender, one lender, a mortgage broker, a private money lender. You should reach out to them and you know figure out what their criteria is.
yeah, no, that's crazy that yeah, because I honestly I would think a lot of borrowers would probably throw in the towel, with all those factors against them. But good
Yeah,
for him for keeping on looking for a loan, and I'm glad you guys were able to do that. That's something else. It doesn't happen all the time. I mean,
yeah.
uh, that's pretty good. What so clients out there getting off on that, you did end that out with that's why it's important to build a relationship. Um, if someone is just building a relationship with a private money lender, um, what is there like, I don't know, let's call it, I don't want to bog down the audience, but is there three questions that people should, I guess, get the answer to consider a private money lender or hard money lender? Like, what would be some, I guess, considerations that a borrower should take before choosing one?
Wow. It's a great question.
Hmm.
It's not so easy to answer because, if you're a seasoned flipper versus a brand new flipper, it's gonna be a little bit of different questions. But one, you'd want to ask like, hey, what's your criteria? What's the max down payment someone would need? What are your typical rates? What's your turn time? How's the process? You know, when it comes to flipping, also rate isn't always the most important factor because you're gonna want execution and you want speed. Because right now there are lenders that are offering lower rates, and now they aren't funding those deals anymore. And now there's a lot of loans right now as we speak floating around looking for a home because they couldn't execute.
Yeah, that
So
would be a pickle as a
yeah,
investor. That's for sure.
yeah. So
I could only imagine.
asked about what their criteria is, what their appetite is, and that'd be one for sure. And you want to find out, hey, where do you lend? It depends where you're flipping, right? So you'd want to know, hey, do you lend in this specific state?
That's all good stuff. Is what's the how can I don't want to turn this show into like a pitch fest, but for those who ask, like, what is it that what kind of loans do you do, and how can people reach you? I am gonna leave your information in the comments section, for anyone that thinks that they would have some questions that need to be answered. I think you're a great resource for that. But yeah, just say I kind of explain like what kind of loans you do and how can they get a hold of you.
Oh man, I pretty much do the full gamut of loans when it comes to commercial loans and residential. So if you're flipping properties, I can definitely do that. If you're doing investment homes like Airbnb or just buying a property to rent, I definitely do those. And when it comes to commercial, apartment buildings, retail buildings, just anything commercial. Sometimes the special purposes are a little bit hard. Like when I say special purpose is like a funeral home or a gas station. It's very unique. They're not like a typical piece of commercial real estate like an industrial property is or a warehouse, but I do all those. And you can find me on Instagram at Private Money Specialists. My website would be down below, my contact information. But yeah, I can be emailed, texted, or you can find me online.
All right. Well, I appreciate it, everyone. I appreciate you guys watching. Thank you again, Rafael, for coming on and giving us the state of it, the state of hard money. And we're going to be checking in with you often to kind of get the state of that. This channel isn't just about that. This channel also we cover just regular residential real estate questions, and just anything real estate, even if you're renting or something like that. This is the real estate toolbox. Like everything real estate goes here. But anyway, I'm Greg. Thank you, Rafael. And please like and subscribe. Leave a comment if you have any questions, and we will talk to you guys soon.